This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
The year was 2008. The global financial system was experiencing a catastrophic meltdown. Lehman Brothers, a massive 158-year-old banking institution, had just filed for bankruptcy. The stock market was in an absolute freefall, erasing trillions of dollars in wealth in a matter of days. Across the United States, the housing market collapsed. Millions of families were losing their homes for foreclosure, and millions more were losing their jobs. On Wall Street, there was no strategy left. There was only panic. Portfolio managers were staring at their screens in disbelief as the entire foundation of the American economy crumbled beneath their feet. But if you looked away from the screaming trading floors and into the quiet, disciplined offices of a relatively unknown hedge fund, you would see a completely different reality. Amidst the greatest financial destruction of our generation, one man was not panicking. He wasn't desperately selling off assets. Instead, he was watching his meticulous, years-in-the-making strategy finally unfold. While the rest of the financial world was bleeding, this man's fund executed a strategic position that generated an incomprehensible profit of $15 billion. It is widely recognized today as the single greatest financial trade in modern history. Many people on Wall Street tried to dismiss his success. They called it a lucky guess. They said he simply happened to be in the right place at the right time, but they were entirely wrong. What this man accomplished was not the result of luck. It was the result of an intense, obsessive level of fundamental research. He saw a massive, dangerous illusion that the entire world had blindly accepted as truth. More importantly, he possessed the ultimate psychological endurance. He had the mental strength to stand completely alone, enduring relentless pressure and taking a position against the entire financial herd. His name is John Paulson. Welcome to Trader's Journey, a part of Trade Alive, brought to you by IUX Education. In this episode, we are going to explore the mind of a meticulous analyst who looked deep into the numbers when everyone else looked away, and how he survived the agonizing wait for the truth to be revealed. This is Mastering the Crash, how John Paulson navigated the housing collapse to make $15 billion. Let's begin the journey. Executed the greatest trade in financial history? We have to rewind the clock. We have to look at the environment that forged his mind. He was not born into Wall Street royalty. He didn't grow up in the elite mansions of the Hamptons. John Paulson was born in 1955 in Queens, New York. It was a solid, hard-working, middle-class neighborhood. In Queens, you didn't get ahead because of your family's last name or inherited wealth. You got ahead through relentless, grinding hard work. Even as a young boy, John was noticeably different from his peers. While other kids were outside playing baseball, dreaming of becoming athletic superstars, John was fascinated by numbers, logic, and business. He had an innate, calculated mindset. When he was just a kid, he would buy candy in bulk from the local store and strategically sell it to his classmates for a small, guaranteed profit. By his teenage years, while his friends were spending their allowances on entertainment, John was already saving his money to buy his very first shares of stock. He was quietly analytical, always looking for a logical advantage in every situation. This early fascination with the markets wasn't just a phase, it became a lifelong obsession. But Paulson knew a harsh reality. Without an elite education, the massive doors of Wall Street would remain firmly closed to a kid from Queens. So he applied a brutal, uncompromising level of academic discipline to his life. He didn't rely on luck. He went to New York University and graduated summa cum laude at the absolute top of his class. But he didn't stop there. He pushed his way into Harvard Business School, one of the most competitive environments on the planet. At Harvard, he didn't just survive, he dominated. He graduated in the top 5% of his class, earning the highly prestigious title of Baker Scholar. He proved that he could outwork and outanalyze anyone in the room. When he finally entered the Wall Street arena in the 1980s, he didn't gravitate towards the flashy, high-adrenaline trading desks that made people famous. He didn't want to rely on gut feelings or market momentum. Instead, he chose one of the most intellectually demanding, grueling sectors of finance: mergers and acquisitions, and eventually, merger arbitrage. This was a world of no intuition. It was a world of 1,000-page legal documents, complex corporate contracts, and microscopic profit margins. It required sitting in a quiet room for hours, analyzing the exact mathematical probability of a corporate deal closing. In 1994, he took everything he'd learned from his entire journey and founded his own firm, Paulson and Company, starting with just $2 million and a single employee. Because of his background, working his way up from Queens, grinding through the intense pressure of Harvard, and analyzing endless legal contracts, he developed a very specific financial DNA. He hated uncalculated exposure. His entire philosophy was built on a concept called downside protection. Before he ever looked at how much money a trade could make, he obsessively calculated exactly how much capital he could lose. This step-by-step evolution, from a calculated kid in Queens to a meticulous reader of the fine print, created the perfect storm. It forged a man who refused to believe the hype, a man who demanded to look at the raw data. And that is exactly what he did when he turned his eyes towards the booming American housing market. By the mid-2000s, the United States was consumed by an unprecedented financial mania. The American housing market had become an unstoppable juggernaut. The general consensus across the entire country, from ordinary citizens to the highest-ranking Wall Street executives, was a dangerous, unchallenged belief: housing prices will never go down. Because of this absolute certainty, banks began abandoning their traditional lending standards. They started handing out mortgages to anyone, regardless of their income, their credit history, or their ability to actually repay the loan. These highly dangerous loans were known as subprime mortgages. But Wall Street didn't just keep these toxic loans on their own books. They used a process of financial engineering to hide the risk. They took thousands of these terrible, high-risk mortgages, bundled them together into massive financial products, and then paid the credit rating agencies to stamp them with a pristine, risk-free AAA rating. They were essentially taking financial garbage, painting it gold, and selling it to the world as a perfectly safe investment. While the rest of the financial world was blinded by greed, blindly buying these so-called safe assets, John Paulson's meticulous defensive instincts kicked in. Remember his background in merger arbitrage. Paulson was trained to never trust the label on the box. He was trained to look at the absolute worst-case scenario. As he watched the housing market explode to irrational heights, he didn't feel the urge to join the party. He felt a deep, analytical suspicion. So he did what he always did. He refused to rely on the opinions of the banking executives on television. He and his lead analyst, a man named Paolo Pellegrini, decided to look under the surface. They initiated one of the most exhaustive, grueling periods of fundamental research in modern financial history. Paulson and Pellegrini didn't just look at the AAA ratings. They bought the raw, underlying data. They manually tracked the performance of thousands of individual mortgages hidden deep inside these complex financial products. What they discovered was absolutely terrifying. The foundations of these massive financial structures were already rotting. They saw that ordinary borrowers were already beginning to default on their loans at an alarming rate. They calculated that if housing prices stopped rising, even just flattened out, millions of these subprime borrowers would be completely unable to pay their mortgages. The default rates would skyrocket, and the bonds that held them would become entirely worthless. It was a moment of absolute clarity. Paulson knew with mathematical certainty that the housing market was going to collapse, and more importantly, he realized that he had discovered the most asymmetric financial opportunity of his lifetime. He just had to figure out exactly how to position his portfolio for the inevitable destruction. John Paulson and his team had correctly diagnosed a terminal illness in the global economy. They knew the subprime mortgage market was going to collapse, but knowing a crash is coming is only half the battle. The real question for a hedge fund manager is, how do you actually execute a trade against the entire American housing market? You cannot simply short a house like you short a traditional stock. Paulson needed a very specific, highly specialized financial instrument, and he found it in something called a credit default swap, or CDS. To understand a credit default swap, you don't need a PhD in finance. Think of it simply as buying fire insurance. If you own a house, you pay a small monthly premium to an insurance company. If your house burns down, the insurance company pays you a massive sum of money. A CDS worked exactly the same way, but with one bizarre, incredible loophole. Wall Street allowed you to buy fire insurance on a house even if you didn't own the house. Because the entire financial world believed that the housing market was completely bulletproof, the cost of this insurance was incredibly cheap. The banks were happily selling these CDS contracts for pennies on the dollar, thinking it was free money. Paulson saw the ultimate asymmetric opportunity. He calculated that his downside risk was strictly limited. The absolute worst-case scenario was that he would just lose the small monthly premiums he paid. But his upside potential, it was virtually infinite. If the housing market collapsed, those cheap insurance contracts would become worth billions. So Paulson systematically executed his strategy. He directed his fund to aggressively buy billions of dollars worth of credit default swaps against the worst, most toxic subprime mortgage bonds they could find. He had built the perfect defensive fortress. But then, the hardest part of the journey began: the waiting. In financial markets, being too early feels exactly the same as being wrong. Paulson executed these massive positions in early 2006. He expected the market to fracture quickly, but it didn't. Month after month, the housing market defied logic and continued to rise. And because Paulson had bought all this financial insurance, his fund had to pay millions of dollars in premiums every single month. In finance, this is called a negative carry, and it acts like a slow, agonizing bleed on your capital. As the months dragged on into late 2006, the pressure became almost unbearable. His fund's performance started to drop. His investors, the people who had trusted him with their wealth, grew frustrated and angry. They looked at the booming stock market and then looked at Paulson's bleeding fund, and they demanded answers. Many threatened to withdraw their capital entirely. On Wall Street, the elite banking executives openly mocked him. They laughed at the quiet, meticulous arbiter who was foolishly fighting against the greatest economic boom in modern history. He was completely isolated. He was executing the loneliest trade in the world. For an ordinary portfolio manager, the psychological weight of this isolation would be crushing. Most people would have surrendered to the herd, liquidated their positions, and accepted a painful loss just to stop the bleeding. But John Paulson was not an ordinary manager. When the pressure was at its absolute peak, he didn't look at the TV pundits and he didn't listen to the laughter of his rivals. He went back to his quiet office and he looked at the raw data. The fundamental data had not changed. In fact, it was getting worse. The actual default rates on the ground were accelerating exactly as his team had calculated. The foundation was crumbling, even if the building hadn't fallen. Armed with undeniable mathematical conviction, Paulson refused to back down. He tightened his grip, absorbed the pain, and waited for reality to finally catch up with the illusion. As the pressure mounted, as the negative carry bled his capital, and as Wall Street openly mocked him, how did John Paulson keep from losing his mind? Why didn't he just liquidate his positions and surrender to the herd like everyone else would have done? He didn't survive because of blind optimism. He survived because his strategy was built on an unbreakable architecture. While the rest of the world saw a man taking a crazy, isolated risk, Paulson was actually relying on three fundamental principles that anchored him to reality. First, he had engineered the ultimate safety net. In professional finance, this is known as an asymmetric trade. Paulson never exposed his fund to infinite destruction. Because he used credit default swaps, he knew his exact mathematical downside. If the housing market kept going up forever, his losses were strictly capped at the monthly premiums he paid. It would be painful, but it would not destroy his empire. He survived the psychological pressure because he knew his worst-case scenario. When your downside is strictly limited, fear loses its power over your decisions. But limiting risk isn't enough to survive the mockery of the entire financial industry. The second reason he didn't break was because his knowledge was not borrowed. Wall Street had become intellectually lazy. Massive institutions were outsourcing their thinking, blindly trusting the pristine AAA ratings given by the credit agencies. But Paulson, driven by his background in merger arbitrage, had done the grueling, painfully boring work that others refused to do. He and his team had read the thousands of pages of mortgage prospectuses. They had analyzed the raw data of the individual homeowners. When you do the deep, fundamental research yourself, you do not need validation from the crowd. You already possess the truth. And that brings us to his ultimate weapon, the psychology of conviction. Being a contrarian, standing against the majority, sounds heroic in theory, but in reality, it is a terrifying, lonely place to be. The market was punishing him daily, but Paulson survived because he completely separated his ego from the market's noise. The television pundits were saying one thing, but the fundamental default rates on his desk were saying another. He chose to trust the math. This is the true secret of navigating a financial crisis. If you want to survive the brutal volatility of the markets, you must construct your portfolio to limit the downside. You must do the raw, fundamental research that the masses are too lazy to do. And most importantly, when the data proves that your thesis is correct, you must possess the iron psychological endurance to stand your ground, no matter how loud the crowd screams at you. With this unbreakable architecture in place, John Paulson absorbed the pain, held his ground, and simply waited for gravity to do its job. Eventually, in the financial markets, gravity always wins. By late 2007 and accelerating violently into 2008, the illusion completely shattered. The subprime mortgages began to default exactly as John Paulson and his team had mathematically predicted. The dominoes started to fall. First, the obscure funds holding these toxic assets collapsed. Then, massive, century-old institutions like Bear Stearns and Lehman Brothers were wiped off the map. The American housing market, the supposedly unsinkable ship of the global economy, violently crashed. But inside the quiet offices of Paulson and Company, there was no panic. As the financial world burned, the fire insurance that Paulson had patiently accumulated became the most valuable financial instrument on the planet. The credit default swaps that he had strategically purchased for mere pennies were suddenly worth billions. The negative carry, the agonizing months of bleeding capital, and the relentless mockery from Wall Street executives were finally over. When the dust finally settled on the 2008 financial crisis, John Paulson's fund had generated a staggering, historically unprecedented profit of $15 billion. Overnight, he transformed from a quiet, ignored arbitrager from Queens into a financial immortal. But his legacy is not just about the money. His story is the ultimate testament to the power of independent fundamental research. It is a masterclass in risk management and downside protection. He proved to the world that the greatest returns in the financial markets do not come from following the herd. They come from doing the grueling work, identifying the invisible risks, and possessing the unbreakable psychological endurance to stand by your data when the entire world is screaming that you are wrong. As we bring this incredible journey to a close, I want to ask you a crucial question. Have you ever abandoned a well-researched trading position simply because you couldn't handle the psychological pressure of the market temporarily moving against you? If you had maintained your conviction like John Paulson, how would your portfolio look today? Share your experiences and your battles in the comments below. Let's build a community of disciplined traders. And if you want to master the art of downside protection, or if you are ready to learn how to conduct professional fundamental research to spot the next major market shift, your next step is waiting for you at the IUX website. We have an extensive library of premium strategies, market insights, and educational tools designed specifically to elevate your trading psychology and protect your capital. Thank you for joining us as we navigated the ultimate financial storm. This has been Trader's Journey, a part of Trade Alive, brought to you by IUX Education. Remember, the market will always test your conviction, and your fundamental research is your only anchor. Until next time, stay disciplined, trust the data, and goodbye.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.